Welcome to the Standard Deviations podcast, presented by Orion Advisor Solutions and hosted by Dr. Daniel Crosby, Orion's Chief Behavioral Officer and New York Times best-selling author. Each week, Dr. Crosby interviews a fascinating new guest on a range of compelling topics, from literature to psychology to financial wellness. To learn more about Dr. Crosby's behavioral finance work at Orion, visit www.orion.com.
Hello and welcome to the Standard Deviations podcast. I am your host, Dr. Daniel Crosby, and I'm joined today by Herman Brodie, author of The Trust Mandate, the behavioral science behind how asset managers really win and keep clients. He's the founder of Prospecta Limited, an organization that helps financial services firms achieve their investment and strategic objectives through the exploitation of practical and impactful behavioral insights. Welcome to the show, Herman.
Thank you very much. It's a privilege to be with you today.
Well, we are both Harriman House authors. I've been meaning to have you on for a while, and it's great to have you here because I think your book covers behavioral finance from an issue that I've never seen covered before. It's truly unique in a world where a lot of it is around biases and sort of investment mistakes. You come at it from a truly unique angle, and I guess where I want to start is with the drivers of asset flows from a behavioral perspective. Because if I were to guess, and I'm admittedly no expert on this, I would guess something like, AUM, size, name recognition, recent performance, cost. These would be sort of where my mind goes. But you found that soft considerations, behavioral considerations, also impact asset flows. So how important are some of the things that I talked about, and speak to where do these non-performance behavioral characteristics enter into the conversation?
Okay, well, I can tell you that at the outset of this, that was my intuition as well. I just assumed that, the best would always win. And so by the best, I mean the asset managers and the financial advisors with the best performance, with the best track record, with the shiniest awards. The winners would be the financial service providers with the greatest demonstrated ability. But it turns out that intuition proved, not totally wrong, but at least it was only partially right. Yeah. So although past performance, yes, is positively related to the flow of assets to and from asset managers, its explanatory power is not very strong. And we looked at all of the data concerning the flow of funds in and out of fund management firms. And it didn't explain a great deal. And one of the most interesting pieces of research that I saw actually came across through us from a Chestnut Advisory Group. And what they looked at is the flows to asset managers in the period, I think it was 2006 to 2013, which we consider to be, a full investment cycle. And what they looked at is the inflows going into managers who were the best at gathering assets. So the top quintile asset accumulators. And then they looked at the inflows going into the managers who had the best performance. So the top quintile best performers. And these were not the same firms. So the top asset accumulators, they attracted on average 4 times as much as the top quintile performance. And with termination decisions, it was quite similar as well. These were not the firms who were necessarily performing the worst, who lost most assets. In fact, in some asset classes, the worst performers actually saw asset inflows over that period. So what we did is we then turned to the self-reported surveys of scores of fund sponsors and investment consultants, as well as some of the personal accounts of some fund selectors, to see the way that they formed their expectations about managers' future performance, and also to see the extent to which those expectations really drove selection decisions. And then we could compare them to the accuracy of those expectations between the asset manager's realized performance. And hard factors like, past performance, age of the fund, size of the fund, fees, and so on, they only accounted for about a third of the evaluation of fund sponsors. And for investment consultants, those soft factors, they carried even more weight. So more than 3 times the weight of all the other factors put together, and almost 8 times the weight of past performance. Now, those soft factors, they included things like, perceived consistency in the investment philosophy, clear decision-making, credibility, this is a word that came up quite often, faith in the ability of the manager to deliver in the future, likable relationship managers, useful reports and meetings, good presentations. Now, I can tell you straight away that neither soft nor hard factors had any predictive power for future performance. None. So you said, what on earth are these people looking for? How are they making their decisions? Why? Well, the thing about hard factors, this is what we found, is that they concern solely the past. So if you're looking at just the product age and past inflows and outflows, it's all about what took place in the past. But soft factors, this is the way that selectors make a prediction about the future. And that's the reason they attach the greatest weight to those things that increase the perception of behavior predictability. So things like consistency. What they want is simple. Clients want to have a relationship with their service providers, a relationship. And hard factors tell them nothing at all about what that relationship will be like. Only the soft factors can do that. And that's what it was all about, Mike.
That's shocking to me. I mean, that research is so revolutionary and so fascinating and counterintuitive that the hard factors only accounted for about a third of the decision making process. So what's the takeaway for asset managers, for financial advisors? It's to really work on the intangibles then, right? I mean, this is your whole work, is to help folks work on these trust factors, these intangibles, to help them make the most of that 2/3 of what we'll call sort of behavioral considerations, I guess.
Yeah. So basically the message is, and in fact, the Chestnut Advisory Group have agreed with me 100% on this, is that your performance doesn't matter. Ultimately, it's the relationship. Clients want to have a relationship. They want a relationship where they know the manager or the advisor really has their back, really understands them, will put their interests first. This is what they want. They want the opportunity also to learn from their advisors and from their investment managers about capital markets, about risk, about investing, and so on. So it's all of the elements that's tied up with the ultimate relationship these individuals will have together. The performance, this is nice to have, but it's not the thing which will drive the client to engage, number one, and for the client to remain with that manager over the long run.
Many of my favorite allocators are also great educators. And I mean, you even look at someone like Warren Buffett. When you look at Warren Buffett's performance, if you look at Berkshire's performance, even over the relatively long term, at least recently, it's impossible to differentiate it from something like the Dow or the S&P. And yet, Warren and Charlie have built this whole ecosystem of communication and all of these folksy aphorisms about how they communicate. People like Howard Marks and his newsletters. These things build trust, they build credibility, they show the consistency, they show all of the things that you talk about. So good performance or competent performance is sort of table stakes. That's the first third. That's second. 2/3. You've got to be a great communicator and you've got to be trustworthy. So let's stick with this idea of trust for a minute, because there's certain words in the business, and I think trust is chief among them, that everyone uses, but no one sort of agrees upon from sort of an operationalization standpoint or from a definitional standpoint. So in your book, you talk about 3 different types of trust. So can you break down the different types of trust? Everybody knows this is important, but help us concretize this and get our arms around these different types of trust and why they matter.
Yeah. Well, as with all things, it's important to have a clear definition when we're going to talk about something. And in the literature, the most widely used definition of trust is that it's a psychological state, and it comprises the intention to accept vulnerability based upon the positive expectations of the intentions or behavior of another. That's the definition. So trust, you should think of it not as an action, but basically it's a state of mind. And when that state of mind prevails at a moment when a person is vulnerable, that person will trust the other if they believe that the other has good intentions towards them. And they believe that, well, everything will turn out fine if I do this. And, well, your clients, they must accept to be vulnerable. This is the starting point. And they accept to be vulnerable on several fronts, by the way, because, yes, they're exposed to material losses, but also there's an information asymmetry. So you know more about what they are getting into than they do. And, of course, clients then won't know how good the service is until long after they've consumed it and paid for it, of course.
Right.
So whether you recognize it or not, you are in the trust business. And clients, of course, they have a choice as to whom they trust. So for them to transact with you, they must be convinced that you are both willing and able to act in their interests. Now, trust, it can develop as a product of personal contact, but it can also be attributed to someone by virtue of the role that person fulfills or because of the rules and regulations that apply to that role. And so we did by looking at trust relationships from varying degrees of resolution, we were able then to distinguish three types of trust. There's system trust, role trust, and interpersonal trust. Now, system trust refers to the confidence one has in the rules and the mechanisms that dictate the behavior of your counterparty. So let's say in the US, this means the rule of law, strict financial regulations, strong democratic institutions, and so on. So this is the system in which financial service providers operate. So when investors hand money over to an asset manager, I mean, they might be anxious about the riskiness of the securities, but they are not necessarily worried that the manager is going to steal the money or the government is going to confiscate it. So without system trust, nobody would invest in stocks or open a bank account or seek credit or even participate at all in financial markets. So by default, all regulated financial institutions will earn some of their clients' trust simply because they operate in a system that the client trusts. So this is not trust that one earns. If you want it, all you have to do is to incorporate your business, in the US and submit to the oversight of the regulator. Okay? Then you have role trust. And this refers to the confidence that we have that people who occupy a certain role have the skills and the ability and the resources to perform it adequately. And the signals that clients are attentive to there are things like qualifications, certifications, and so on, reputations, brands. And so by burnishing these signals, one can win role trust among potential clients. So for an individual, this means only that they have to gain a certification or move from a firm with a weak brand to one with a strong brand, and they will accrue some of this role trust. And then the third one is interpersonal trust. And that's the kind of trust that one individual has towards another specific individual. So interpersonal trust requires some familiarity with the counterparty, and it's related to the other's intentions, to their customer orientation. Now, it's not about likability. In fact, I think there was one study that showed that likability only influenced the client's willingness to recommend one provider to another. It's about the confidence of the client that provider genuinely has their back, genuinely has their best interests at heart, is focused solely on them. Now, all of those three are interrelated, but it's interpersonal trust that's the most reliable. So when you get, let's say, a financial crisis like we had in 08 and 09, so imagine faith in the system, might be shaken. One can still have confidence in the firm that manages one's money. You can say, oh, that firm will take care of me. And let's say that, there's even some people in that firm who have been shown to have, let's say, failed in their responsibilities. One might still trust Daniel Crosby to do the right thing for me.
Yeah.
So interpersonal trust can survive, even when role trust and system trust have been compromised.
I think I'm going to try not to get in trouble with compliance here. So I'll speak at a high level. I think we're at a moment in time where system trust is flagging. I look at the London Metal Exchange, who recently halted trading in nickel to seemingly protect some high profile clients. That's dangerous. That's dangerous for system trust. You look at some of these large tech names in China, and I won't name individual securities to keep out of trouble with compliance, but you look at some of the largest tech names in China now that are trading at a sub 10 PE multiple, and yet people are scared to go in because they know that the CCP could come in and shut down this operation at any time. And clearly in Russia, we see a total erosion of system trust. So at a macro level, that has to be there. But at the micro level, you anticipated one of my questions, which is which one of these pillars of trust looms largest? And it seems like interpersonal trust is really where we can make some headway. And when the whole world is falling apart, that's sort of our last line of defense. What do we do then, Herman, to build that interpersonal trust insofar as that's the one that's perhaps most in our power?
Yeah. Well, I can tell you even since 08, 09, trust in the system has been declining. Sure. So in the financial plumbing, trust in that has been declining since the financial crisis. Trust in governments have been declining from even before then. And so those other kinds of trust become increasingly important. And in a sense, it's a wonder that more people are not focusing on interpersonal trust, given that there are no hurdles to prevent anybody from doing so. Mm-hmm. So it's a wonder that financial institutions and financial professionals have not dedicated more time and energy towards this, which is, of course, the motivation for putting the book out there in the first place. But do you know what the world's most trusted profession is? It's actually firefighter. Now, in many countries all around the world, firefighter is probably in the top 1 or 2 of the most trusted professions. And when you think about the 3 types of trust, it's easy to see why. Firefighters, they operate in a system that is trusted. So if my house is burning, I call 911, I expect to be connected to the emergency services and the firefighters will be dispatched to my address. I trust the system because it's been designed in that way. Firefighters, they also benefit from role trust. They are presumed to be very well trained. At least people perceive rigorous training and fitness requirements for firefighting. Mm-hmm. So if one occupies this role, if one's been given this role, then people believe that one has the skills, the ability, the resources to perform it adequately. Mm-hmm. But more importantly, people perceive firefighters as selfless. Mm-hmm. They have this customer orientation and benevolent intentions. These are kinds of people who would be willing to throw themselves in harm's way to protect those who are vulnerable. So they benefit from interpersonal trust. But, most people, they don't have much direct contact with firefighters. And they don't get to choose who their firefighters are going to be. But there is a profession whom usually we get to choose, and who we hope will protect us when we are vulnerable. And that is the profession of physician. Yeah. When we think about, let's say, the education and training that goes into a physician, we think about the complexity of the task. But the profession of doctor is not that far removed from that of an investment manager or a financial advisor. So we have to ask, why is it that doctors are trusted, or at least more trusted than these financial service professionals? And why is it that financial professionals really should seek to have much better trust relationships with their clients, and this irrespective of their top performance or their professional capabilities? Now, with doctors, scientists, they have discovered that trust in this relationship increases patients' willingness to seek care. So if somebody feels unwell, they're more likely to consult a trusted doctor than one who is not trusted. When they get to the doctor's office, they're more likely to disclose the kind of sensitive information about their condition or about their lifestyle if it's with a trusted doctor. Now, both of these things mean that the doctor is in a much better position to make an accurate diagnosis and then to be able to help those patients. So you can see that this brings some very big advantages to patients. Then the patients are more likely to submit to the treatment recommended by the trusted doctor, so without going off and seeking a second opinion. And they're more likely to stick with that treatment over the full duration. So once again, you see that this behavior contributes to better health outcomes. And patients are more likely to remain with the trusted physician over time and to recommend that physician to others. So there's some advantages for the physician as well. Now, the average financial service provider would want nothing more than be able to simply to replace the word doctor with asset manager and the word patient with client in all of those statements there. Asset managers, they want clients to come to them when they need delegated asset management. They want those clients to disclose their genuine goals, so their career goals as well as their personal goals, not just the investment objectives. And they want the clients to submit to the treatment, meaning the investment strategy, and to adhere to it over the full cycle. And of course, they want clients to remain with them and to make referrals. Now, the finance literature suggests that all of these things are possible. And there was one study. What it tried to do was to evaluate the impact of a high trust relationship between financial advisors and their retail clients. It was called, curiously, it was called Money Doctors, although the authors actually talk about the studies in the Medical Professional Trust. But the conclusions were very, very similar. So trust in an asset manager has the effect of reducing those investors' perception of the riskiness of any given investment. So basically, clients can sleep a lot easier at night in the knowledge that their assets are in the hands of a trusted manager. And this reduces the anxiety. It allows them to hold durably riskier portfolios. And of course, you would expect an investor who holds riskier portfolios over the long run to earn higher returns. So the high trust relationship brings very big advantages for the client. The trust, it also encourages investors to remain with the manager and so not get involved in costly transitions from manager to manager. And so those savings represent an obvious advantage for the clients as well as for the manager. And the high trust relationship also indicates the likelihood of fewer disputes, fewer lawsuits, and fewer discussions about fees. So that was very, very interesting.
So you've made an incredible case here that trust is a holistic good. It causes people to seek out services in the first place, so it helps with sales, business development. It causes people to stick with the advice that you do give, which we know is an enormous problem in the behavioral finance literature. We know that only about half of financial advisory advice is implemented in the way that it's delivered, so it helps with that problem. You're going to have fewer complaints, fewer conversations about fees, stickier client relationships. I mean, it touches every positive part of an advisor's life cycle. And yet we know from survey after survey, the Edelman Trust Barometer, the most recent one, found that financial services was the second least trusted profession, only ahead of social media, which is a horrible place to find yourself. Only in front of the hated social media.
Mm.
So Herman, where are we falling down? Is it at the system level because we have a lack of faith in the financial system? Is it at the role level? Do we need greater, higher hurdles for people to train the same way that we train doctors? Because I think at least in the States, there's a lot of variability in the level of education for someone who can call himself or herself an advisor. Or is it really at that interpersonal level? Where are we falling short? And could we ever be trusted at the same level of, if not a firefighter, perhaps a doctor?
Yeah. Well, the thing with with system trust, this is not trust that you earn or can really influence. It's got nothing to do with you. And in fact, all of your competitors face exactly the same hurdle. So the problem is not there. With role trust, yes, something can be done about this. Like I say, if you don't have the necessary qualifications and certifications, etc., for an individual, this is a question that can be addressed. But overall, you see that the requirements are genuinely rising in the US and other places in the developed world, the rich world. The requirements for becoming a financial advisor are getting more and more stringent. So this is lifting the level of role trust globally. But again, this is not going to really help you compete. What is going to help you to compete is working on the interpersonal trust side of things. And this was the entire focus of the book, essentially. These are the strongest predictors of trust come from things like the communication style and the interpersonal skills. It's definitely the case with the studies on physicians. And you'll probably also notice that in stark contrast to financial professionals, physicians, they don't dwell on their competence. They recognize that, well, it's a given for most patients. Most people generally believe that their doctors have the skills, the ability, the resources, etc., to help them. And financial advisors, other financial professionals, are also treated in the same way. People generally believe that, yeah, these individuals have got the skills to do this job. The difference between them and doctors is that doctors, they don't talk about their competence too much. And this allows them to focus on conveying their benevolent intentions to their clients. How are you feeling, Daniel? Where does it hurt? How can I help you? And this is how they secure perceptions of trustworthiness.
You make a great point here. With respect to the system, we're all swimming in the same water, right? The system is what the system is. With respect to roles, similar thing. The hurdles to get into the profession are what they are. Most people assume a level of competence. It really is about setting yourself apart at the interpersonal level, because to use a medical term, that bedside manner, right? That bedside, that rapport that you develop is going to be the real differentiator. And you got to read the book to know how to do it. You got to buy the book. We're going to sell some books here, Herman.
And the thing is, when medical practitioners train, they are trained on bedside manner. So it's recognized in their training that this is absolutely essential to patient outcomes.
Yes.
But in the financial services sector, not so much.
Not so much. I think we're getting there slowly. I mean, you see the added emphasis in the CFP curriculum on psychology, which is, again, different than bedside manner. I mean, knowing sort of a list of behavioral biases is still different than knowing how to develop trust and communicate. But I think incrementally we're moving in that direction. We've talked a lot in the last few minutes about competence. Another sort of mental model that I've heard referenced before that I saw again in your book was this mental model around warmth and competence. Can you talk about the 1-2 punch of warmth and competence and why that is so important in building trust?
Okay. Well, warmth and competence, this comes from the stereotype content model. It's Amy Cuddy, Suzanne Fiske. Mm-hmm. And the model proposes that when we human beings form an impression of someone, we do not do so on a single scale of good or bad. We actually do it along 2 dimensions. Now, the first of those dimensions is warmth or benevolence, as I prefer to use. And this is our perception of the other's intentions towards us. Do they have our best interests at heart, or do they have their own selfish interests at heart? And the second impression, competence, is our perception, again, of their ability to act on those intentions. Now, the first impression is the most important of the 2. So evolution has equipped us with the ability to infer a stranger's intent within a fraction of a second. Mm-hmm. And this allows us to formulate very quickly an initial response. So is this unknown other a friend or a foe, one of us or one of them, a giver or a taker? Does the stranger have friendly or unfriendly intentions towards us? And this is always the judgment that's made first, because it will determine our approach or avoidance response. Thereafter, a judgment is made about the other's competence. So in other words, the ability to act on those intentions. So as its most basic, it's like, can it eat me or can I eat it? If the stranger is judged to be, let's say, hostile and powerful, so it wants to take and can take, then flight is the obvious response.
Right.
A powerless hostile who wants to take but probably can't should be fight. Fight is the correct response. We should crush them. But those we judge as having benevolent intentions towards us, or a powerful friend, one who wants to give and can give, this makes an excellent companion. Mm-hmm. And even a powerless friend, so one who wants to give but probably can't, might still prove useful to us. Who knows? And the research right across the world has revealed that these impressions are genuinely universal. So everybody is making these judgments. So even the clients of financial service providers. Does this professional have the ability to make good things happen? And are they motivated to make them happen for me? That's the question. And in this industry, well, I say professionals, they dwell massively on their competence when trying to win and to keep clients. And they often neglect the first dimension, which is benevolence. So even though it's the first to be reached, and it's also the more important of the 2. I mean, a smart, skilled, resourceful professionals, they're only useful if they are on our side. I mean, if they're working against us, well, those smarts are no use. Those qualifications, those skills, they're no use to us if they're using them to undermine my position. Now, we prefer our enemies to be dumb. So the focus of the book is really how to cultivate these perceptions of benevolence, because I believe that financial advisors do have benevolent intentions. They're just so reluctant to show them. They still prefer to push the competence domain down the throats of their potential clients, even though the client already perceives them as competent.
It's true. So first of all, I'm sitting here thinking about the average first advisor client sort of onboarding meeting, and it's so competence heavy, right? It's so focused on competence and sort of the meat and potatoes of financial know-how and the basics of asset allocation and risk mitigation and these sorts of things. But it's fascinating to think that your competence could actually become a weapon that's used against you. if it's delivered in a cold, sterile, aloof sort of way, someone can go, wow, like this person's very sharp, but do they care? And that could actually become a strike against you if that competence is sort of applied heavily in a vacuum. So I love any sort of mental model that allows me to do a sort of a self-check in a very simple sort of heuristic sort of way to say, look, let me look at my day. Let me look at the meetings I've had with my clients. How warm was I? How competent was I? And know that we as an industry are probably erring heavily on the side of competence. I think that's such a useful and cross-cultural way to think about how we're serving our clients. I love it. So, Herman, the last question before I let you point people towards your excellent work, I couldn't leave this one alone because I'm a huge fan of the Big Five personality measure. And you've written a paper on how understanding client personalities using the Big Five model can give advisors insights into their clients. And one of the things that I'm always working on is I want the advisors that we serve at Orion to be the best educated with respect to their clients. I want them to know their clients better than they know themselves. And that's always sort of my goal. And I think the Big Five is a useful rubric for gaining that type of understanding. And you've written about that. So can you tell us ever so briefly, what are the Big Five and how can they be applied to deepening understanding between clients and advisors?
Okay, so the Big Five is a framework for understanding human personality. So the differences in people's behaviors across situations and across individuals. And basically, since the 1970s, scientists have agreed that basically there are just 5 principal traits that explains those differences. And they go right across cultures and languages. And this is what's meant by the Big Five. And since then, well, we've been looking at them and using them to explain behavior, relationships across a range of different individual outcomes. I mean, some trivial things like musical preferences and dress, but also some major life outcomes like in education and job performance and health, both physical and mental. And they've taken advantages of those relationships to help guide people towards satisfying careers and driving educational attainment and, of course, improving health outcomes. But in the last 10 years, economists as well have now taken an interest in the Big Five, and they too have discovered some very reliable associations between people's personality and outcomes like wealth accumulation, retirement planning, spending patterns, indebtedness, and also in risk propensity. So imagine that we are armed with knowledge of our clients' personality profiles. Then we would be able to anticipate some of the headwinds and sometimes even tailwinds that those clients are likely to encounter from a personal finance perspective, possibly even before the clients know it themselves. And one could also deliver a customized service. So a service that would be more effective, deliver some better outcomes, and certainly attract some greater client satisfaction. That was the idea. So let me just break down what the Big Five personality traits are. They are known as openness, conscientiousness, extroversion, agreeableness, and neuroticism. And the acronym OCEAN helps us to remember all 5 of them. So the first one is openness to new experiences. And that really describes the depth and the breadth and the complexity of people's thoughts and actions. So open people have a great tolerance for the unfamiliar, for the ambiguous. They're constantly looking out for novelty and originality. They're creative, imaginative, those kinds of people. And when it comes to the relationship between openness and wealth accumulation, what has been found as key characteristics is that open individuals have a higher tolerance for risk. And their openness means that they're open to investment proposals, even long-term investments, and opportunities in unfamiliar or perhaps unconventional investment tools. There's a potential, therefore, that over the long run, they can enjoy higher returns. However, there's this constant pursuit of new experiences. This also tends to be a drain on their budgets. So there's a tendency for them to spend more than others, especially on things like travel. And they have a tendency to take on higher levels of unsecured debt. The next trait is conscientiousness. And this describes people's self-motivation towards specific goals. Now, these people they tend to be very planful, well-organized. They can work steadily, diligently towards their objectives, and they have a great capacity for self-control. Conscientious people, I tell you, they tend to be healthier than everybody else to start with, and they also tend to live longer. And it turns out, because they're so forward-looking, you see, they think about the consequences tomorrow for the things they do today. So if you think about those high-risk activities like smoking or substance abuse or unhealthy diets, conscientious people are more likely to avoid such things. And when they get sick, they tend to follow the recommendations of their healthcare providers. So if the doctor says, well, you better cut this out because your blood pressure is too high, conscientious people tend to follow that recommendation. And consequently, they tend to have better health outcomes. Now, you can imagine already that for conscientious people, these are the kinds of individuals for whom wealth accumulation is relatively easy. Mm-hmm. And the data does bear this out. The wealthiest among us are very often those who score highly on the conscientiousness trait. They're conservative, yeah.
It's also the characteristic that most directly corresponds with success in the workplace. So it's easy to see how high conscientiousness gets you a good job and also gives you a framework for being a great saver. I think it's a great example.
Yeah, exactly. They have high levels of saving than everybody else. It's because they can delay gratification.
Right.
And they also do things like taking on less unsecured debt. Mm-hmm. You look at their portfolios, they will have a higher proportion of stocks, mutual funds, and real estate. Then we have extroversion. Now, extroverts, these are people who genuinely enjoy the company of other people. So they draw great satisfaction from being with others and exchanging with others. They tend to be more talkative and energetic and assertive. And in a group, they will more readily take the lead. And they also have a tendency towards excitement seeking. Now, in the domain of career development, the researchers, they found that those who score highly on this extroversion trait, they tend to do better in jobs which involve sales and management and leadership. Mm-hmm. But we're focusing on wealth accumulation. And when it comes to wealth accumulation, extroverts, we find, tend to spend more than other traits. Mm. So the desire to socialize, well, this comes at a cost. And they will spend a lot of money on dining and drinking and on status symbols, so conspicuous spending. And as a result, well, extroversion tends also to be a drain on the ability to save. And they're also more likely to take on unsecured debt. And because they're sensation seekers, sometimes this leads them towards short-term trading, day trading, and so on. And that's not an activity that's consistent with long-term wealth accumulation.
Right.
Then for A, the agreeableness. That's the next one. And this describes the degree to which people tend to be more pro-social and less self-orientated. So agreeable people, they don't like interpersonal conflict. So they tend to be very accommodating of other people, and they have a tendency towards altruism. So they have a great capacity for sympathy and empathy and compassion. Mm-hmm. Now, for their personal finances, then agreeable people's tendency to put the interests of others ahead of their own, this often results in outcomes that are going to be detrimental to their personal wealth. Mm. And so the research has shown there's a negative correlation between wealth accumulation and agreeableness. Mm. So their savings tend to be lower. Their retirement preparedness tends to be worse. This tendency towards altruism very often gives rise to high levels of charitable giving and sort of inter vivo wealth transfers. And there's also a negative relationship between agreeableness and earnings. So agreeable people, they tend to be very poor salary negotiators. Now, if you want to be a tough negotiator, get your own way, then you have to be ready to put other people's noses out of joint. And this is something that agreeable people are simply not prepared to do. Tough negotiators, they tend to be rather disagreeable. And so there's a negative relationship between agreeableness and earnings. And there's also a negative relationship between agreeableness and credit scores, to be perfectly honest as well. And then we get to the final one, which is neuroticism. And that describes people's emotional instability. So neurotics tend to be more nervous, more tense. They tend to have more erratic mood swings. They become anxious more easily, and they tend to worry a great deal. Now, remarkably, and I found this quite surprising, that for their personal finance outcomes, there is no evidence to relate neuroticism to wealth accumulation.
Very surprising.
Still surprising. I was quite surprised by this.
That's surprising. But
they do present some tendencies, which means that their experience of investing is going to be quite painful. They tend to be very loss averse. So they perceive the pain of a loss more intensely than the pleasure of a gain for the same dollar amount. And they also tend to monitor very closely their investments, especially during downturns. But the thing is, and mercifully so, they're also regret averse. And this fear of doing something they might regret reins them in a certain way and stops them from overtrading. Hence, it doesn't spill over into their wealth accumulation. But nevertheless, you can still see why capital markets are going to be such a frightful place for people who score high on the neuroticism scale.
So you've given us an absolutely brilliant breakdown of the big five, and I think especially how they pertain to specific wealth building behaviors. I don't, to put you on the spot here, I don't know if you've done any research on this, but when you think about the fit, like the goodness of fit between an advisor and her client, you know, on something like neuroticism, each of these big five have pluses and minuses, you know, if you're sort of at either of the poles. So let's say a client who is highly neurotic, who's highly anxious, who's highly stressed out, and for whom the investment journey may be fraught and difficult. Does that person want an advisor with a similarly high level of neuroticism so that there's a degree of shared experience and empathy? Or do they want an advisor with very low levels of anxiety who is perhaps able to counterbalance their more natural neurotic tendencies? How do you think about where folks should be similar and where they should be different when we're talking about pairing an advisor with a client?
Certainly, there are possibilities to match up. Now, of course, no individual is just one trait. So everybody has elements of all of those big five, just to varying degrees. So there are some things which are likely to be stronger with some people and some things which are likely to be weaker. So everybody is not just one thing. That's the first thing to point out. But there is no magic solution, no square peg for a square hole. That doesn't work in this way. What is absolutely essential, though, is a good level of self-awareness. So I need to know not only who I have in front of me, but what about my own personality? I'm happy to work with neurotics if I have the kind of personality. I don't need to be neurotic, but I need to be able to understand this and to successfully negotiate it. Now, if that's something that I can do, if I have the necessary patience and compassion and understanding to be able to work with people who are neurotic, I can still be successful with that client without being neurotic myself. And so the issue is not what's the best kind of advisor for the certain type of client, but it's a certain amount of awareness of the kind of person I have in front of me and a self-awareness about the kind of person that I am and what I can and cannot do.
each of us moves through the world in this sort of N of one, right? Our experience is our experience, and we don't understand how other people see the world and experience the world differently. So I think the power of the Big Five is understanding where along that sort of personality continuum we sit. And if two people are in a relationship, advisory or otherwise, I think it's so powerful, like you said, to have that mutual self-awareness of, look, here's your natural predisposition to be, more or less of this thing. And then here's my natural predisposition. Let's know that about each other, and let's have a good conversation and take that into account when we're making decisions. So
right.
If you're a fan of personality psychology, I can't recommend the Big Five to you enough. There are a lot of other pseudoscientific sort of junk personality assessments that I won't name because they have big fans. But if you're interested in personality science, there's no substitute for the Big Five. And Herman, you've done a beautiful job of breaking it down. So I study this stuff all day long, and I have learned a ton today. I know that my listeners will be able to say the same. If people want more of this good stuff, if they want more of this great research you're putting out, where can they buy the book? Give us the name of the book one more time. Where can they learn more about you and your firm?
Okay, so the book is called The Trust Mandate, and it's available at all good booksellers, of course. There's also a dedicated website, which is thetrustmandate.com, all one word. To find out more about Prospector, you go across to prospectorbriefings.com, all one word once again. And you'll find some more information there about the kind of work that we do. So basically, we're using behavioral sciences just to solve everyday business problems, whether this is client relationships or trust or whatever this happens to be, or the profit problem as well. All the kinds of topics that we have focused on in the past and we're working on at the moment. And if you want to get your hands on that paper about the Big Five and looking at its relationship to the financial services industry, and we talk about not only what the implications are for the clients, but I also talk about the way that various Big Fives seek information and take that information on board. And also look, according to the Big Five, the way that it's possible to influence people according to their Big Five traits. So what are the persuasion techniques that individuals are more amenable to? Quite simply because giving advice involves behavior change. So either getting people's behavior to be more in line with their objectives, or if that's not possible, one has to convince people to adopt objectives that are in line with their behaviors. But one way or the other, advisors, they have to dig deep into their toolbox to find the most effective ways of going about it. So that paper, it appeared in the Investments and Wealth Monitor. That's the bi-monthly educational magazine of the Investments and Wealth Institute. I believe it's behind a membership firewall, but that's where that paper is. And that's it. And, well, I will be, anybody who wants to see me live, then I will be also at the Investment and Wealth Institute, ACE Academy in Nashville this May, talking on two separate themes, neither of which we covered today or had time for.
Well, I grew up about an hour and a half south of Nashville, and I don't live that far from it now. So I may have to roll on through and get to meet you in person. So Herman, thank you so much. You have shared a mountain of wisdom with us today, and I appreciate all that you've shared. Thank you so much.
You're very welcome.
Thanks for tuning in to Standard Deviations. If you can't wait till next week for more behavioral finance insights, visit www.orion.com. All opinions expressed by Dr. Daniel Crosby and podcast guests are solely their own opinions and do not reflect the opinion of or endorsement by Orion and its affiliates, subsidiaries, and employees. This podcast is for informational purposes only and should not be relied upon as a basis for legal, tax, and investment decisions. The opinions are based upon information the participants consider reliable.